Hey, everybody, welcome to the live stream. It is a Tuesday on the second big day of earnings this week. We had some huge earnings announced today, starting with Google Alphabet, but we've got some other companies of interest that I wanted to cover today and take a look at what they had to announce. Let's take a look at the markets and then dive into what was announced today on the earnings reports. So, real quick glance at where the markets ended up. The stock market ended the day on the downside for the Dow. The S&P was up a little bit and NASDAQ was up substantially. The Russell struggled a bit and it was down quite a bit. I know I noticed that Meta did really well today, as well as Google Alphabet. So that is probably what helped the NASDAQ do well. And Bitcoin, I wanted to cover just lightly. It is up above 70,000. That is important as we look at Bitcoin, an alternative asset class. And what was interesting was back when we had an election in 2020, it was in the November timeframe. From that point, Bitcoin really took off. I mean, it went up 300% in the course of like 5 months. Is that going to happen? I don't know. I'd be a happy camper if it did. Right now, I'm a happy camper with Bitcoin selling at 72,000 per coin. That's a very good price. So I am happy to see Bitcoin doing well. And that does it when Bitcoin is high, so is Coinbase stock. So I own both. That's doing really, really well. Glad to see it. And it looks like Tomas, you are on. Very good to see you. It's a big day. We'll go over the biggest names in the market. Google Alphabet announced after the market closed. So did Visa, AMD, Stryker, Chubb, Chipotle, and Mondelez. Those are the companies I'm going to cover. If there's any paid members out there, you want to see a stock, please put it in the chat. I will mix it in. But I've got a pretty good agenda to work with. I hope you guys enjoy it. Hope you find it interesting. So let's get into the big market cap for today. And that is Google Alphabet. So in after hours trading, the market really liked what Google had to say. The stock is up 5.35%. After a day when it went up 1.66%. So needless to say, Google Alphabet's having a terrific day. Very good, valuable company. We look at 5 years, Google has been taking care of business. It's up 165%. It offered up a terrific time to buy the stock in 2022. More recently, look at the price just in March of 2024, $136 per share. Great time to buy shares, which I did. And the stock is, I think, going to really move up and to the right. And the reason I say that is that I always like to look at companies and put them in the desirability quadrant. And this is the quadrant that I use when I look at companies and try to assess how valuable are they. And Google is most definitely to the furthest up and to the right on the desirability. And the reason for it, you have a business that's like no other. Their search business is number one in the world. It's doing terrific. They have the YouTube business, which is the number one streamer in the world, doing terrific. Their cloud business is doing great. And their robo-taxi business is number one, no matter what Tesla says. The robo-taxi from Google is doing quite well, and it's already operational. Just think of that, what that platform is going to do, along with the other platforms they run like Android and other businesses. Great job, Google. It just doesn't get any more desirable than the Google business for me. Coming back to their financials, let's take a look at their market cap. It's a $2 trillion market cap company, and their PE isn't all that outrageous, 24.5 in the current year, and next year it's supposed to drop to 21. That's very good. They pay a tiny dividend, and analysts believe the stock is discounted. I'll show you where I value the company in a bit. Let's see if we've got, it doesn't look like the details from the latest quarter have made it into the stock analysis. Understandably, they just announced, call it an hour and a half ago. So it would be a little too optimistic for me to say or think that. Now, when we look at the earnings report that they released, this is Google Alphabet's earnings. Revenues increased 16%, or 15%, I should say. 15% is their growth, which is phenomenal in the quarter. Just in the quarter, they did $88 billion. You think about some businesses out there, they do a couple billion and they're very happy. Google's like, they grew in the quarter, just for the quarter, they grew about $12 billion of revenue. Just a terrific, powerful business in Google Alphabet. Their operating margin, 32%. Net income, $28.5 billion. This is just a money-making operation, and they got there by being the best in the markets they chose to operate in, starting with search, then moving to YouTube. Now they're in the cloud business. They're taking on autonomous robo-taxis. They have just terrific businesses, and it's really showing up in value for Google. Looking further, as we look at their businesses are all clicking. Their search business expanded. YouTube ads expanded. Google Network contracted a bit. So overall, the advertising assets went up by over $6 billion. Then we have subscriptions that went up by $1.3 billion. Google Cloud expanded by $3 billion. And overall, the company really expanded by $13.7 billion. Incredible. Excellent. Very well done. Congratulations to Google, all the employees at Google, their management. Now, when we look at the balance sheet, we see that total cash and marketable securities, $93.2 billion. Humongous number, just incredible number. They have more cash, I believe, than debt. Long-term debt is only $12.2 billion. So needless to say, they have an excellent balance sheet. And here is statement of income. I'm trying to get to cash flows. So here is cash flows. So for the quarter, their cash from operations was in line with what they did last year in the same quarter, $30.7 billion. Now, the CapEx, which is also called purchases of property and equipment, this is an interesting number. This is the number that investors are looking at to see if NVIDIA is going to continue to rally. And it looks like Google is putting a lot more money into their business. It's probably going to that cloud business that's trying to sell AI-related services to its customers so they can build out large language models, AI applications. It's net in the quarter, they had $17.7 billion or $0.6 billion of free cash flow. And year to date, you can see that their CapEx has really moved up when you compare the first 9 months of 23 versus the first 9 months of 2024. It's gone up $17 billion in CapEx. That is a lot of billions. So overall, the free cash flow is going down from previous years, but I'm okay with it because they're strategically trying to be a leader in the AI business and maintain the dominance in search, which could at some point really be bringing together AI along with search. I'm all for it. I have no problem with it. And it seems that the market is okay with it as well. I think the top line growth looked great. Their search business is not under any kind of threat from competitors. So Google Alphabet is really desired by many investors, and it's great to see the stock go up. Let me show you the valuation I have on Google Alphabet. Right now, I'm an owner of $155,000 of Google stock. Tomorrow will be 5% higher. That'll be nice to see. So maybe it'll be around $162,000, $163,000. When I look at their valuation, we get to Google, and you see how the cash isn't really doing great. And I don't get a favorable discount when I value the company based on cash. But when I look at their earnings per share, holy smokes, it just is growing, it's profitable, and it's really discounted if I use the earnings per share method. And that's why I like looking at both. 66% of my valuation is based on free cash flow, and a 1/3, 33% based on earnings per share. So overall, I still think that Google Alphabet is discounted by 32%. Tomorrow, that'll move down to, I don't know, 26, 27%. But it's still a buy in my book. I have a desire to keep accumulating shares of Google Alphabet because they will continue to be a valuable company, a consistent, dominant player that is going to appreciate in value. And I think out of the Magnificent Seven stocks, this one's the one that I like the most, just based on valuation and the strength of the business, the value of the business. All those things put together lead me to want to buy more shares of Google Alphabet. So Google Alphabet was a terrific, terrific stock today. Up, if I add the after hours trading number with today's trading, collectively, it's up 7%, which is a very good day for a big market cap company. Good to see that. Congratulations, Google. So we went over Google. Now let's take a peek at Visa. So Visa was down in regular trading, but after they announced their earnings, the stock is up 2%. This is a really consistent stock. One thing about Visa is that if you look at their chart, really nice up and to the right chart, and investors should be happy. They're up 56.7%, and they've been paid a dividend. So maybe collectively, investors are up 62% or so, 64%, if you compound those dividends. Now, that's not going to set any record books, but it is a consistent company. Over the last year, it's up 23%. So, hey, that's a pretty good performance from a stock. The market cap is high, 536 billion, revenue of 34.9 billion. Their PE is 30, not as good as Google. Forward PE is 26. So it's interesting that Google has a lower PE than Visa. And collectively, analysts think that it doesn't have as much of a discount as Google has, which is interesting. When I look at the Visa business, I think it's a really desirable business, but I put them slightly in the gray. And the reason for it is, Visa's competing against the next paradigm in payment processing. So they're competing against Venmo. They're competing against Cash App. They're competing against crypto. They're competing against other forms of payment like buy now, pay later. Those things are a threat to Visa. Visa, the concept was created in the early 1960s. So we're coming up on 60 years of this technology and this paradigm working, which has been a very, very good franchise for them. But at some point, I think that 3% that they tend to charge for transactions may be at risk. If it is, look out, this stock's really going to drop. But for now, it's a valuable company. A lot of people own it. And I put it mostly in the desirable zone, which is mostly green, and a little piece of it in the gray. So Visa announced, let's see what they had to announce. I will go to the earnings in the investor page. All right, so looking at their earnings. So net revenue, 9.6 billion, an increase of 12%. That's really good. 12% is really, really good. They're a big company. And profitability for the full year, they've grown 10%, which is very good. Net income, 5.3 billion. Very good. So revenue growth is there. Net income growth is there. Very good. Payment volumes look good. And the economy seems to be in a good place. The economy is expected to do okay in 2025. So the volume should be good for Visa. We'll see how things sort themselves out over the next 12 months. Trying to see if they have any other financial statements other than the highlights and see if that is available to us. All right, so here we go. So here's the income statement. All right, nothing notable there that I could see. Everything's in line. Year-to-date revenue, 10%, 12% is the in-quarter growth. Balance sheet, cash did come down a little bit. I don't think they have any trouble with their balance sheet. Long-term debt's only $20.8 billion, and they have $12 billion of cash. So $8 billion of net debt. That's not very much for a company of this size. So they are doing just fine there. When it comes to, this is the income statement shown a different way, but this is the statement I want to look at is cash flows. So cash from operations was flat compared to last year. And the net income was higher, but what brought down, looks like the client incentives were much higher, which caused a erosion of cash. So that's what caused cash to go down slightly, even though net income went up. So that was one of the effects of the current year. Now, when we look at the plant, property, and equipment, not too much. They don't have to put much into their business. They have the network already built out. And for the 12 months ended, their free cash flow is about $18.7 billion, which is a very good cash flow number, a little bit lower than last year. Last year was about $19.7 billion. So they're about $1 billion lighter than last year. When we look at their free cash flows over time, I believe it's very consistent. It's a good cash flow generating company. You can see their cash flow is really good, but it did dip a little bit, about $1 billion in free cash flow. I don't think it's, cause to alarm anybody. Visa is a consistent company. I don't own Visa, but I think that a lot of people do own it because of its consistency, that it is number one in its category. It does have a dominant position. It does have good barriers of entry. So congratulations to Visa stockholders. You're up a little less than 2% in after hours. How you doing, Brad? Very good that you joined. So Pfizer, we can take a peek at Pfizer. Pfizer had a very good earnings report, in my opinion. They grew in the quarter substantially, but the market, just didn't like something about Pfizer's, release, and it kind of discounted the stock. And let's take a look at in the quarter, 33% growth in revenue for the most recent quarter close when you compare it to the previous year. To me, that's great news. The story that I'm following of Pfizer is that their business is going to begin to expand, and you're going to see their cash flows begin to expand, and you're going to see this stock really move up, in my opinion. I'm a Pfizer stockholder, just to let you know where I stand. Disclosure on this stock. Everything I ever share is never financial advice. I never recommend you buy, hold, or sell a stock. I'm just sharing my experience as an investor. I'm an investor in Pfizer, and I'm really happy with the revenue growth. The market, had a different attitude toward the stock, and I bought more shares today. I actually bought about $2,000 of Pfizer. I thought it was an opportunity to buy into the stock. So good job, Pfizer. And that's what happened with Pfizer today, Brad. All right, so we went over Pfizer just real quick. Let's move on to the next one. And the next one that I wanted to look at was AMD. And AMD is really selling off. Holy smokes, it's down 8%. What is going on, AMD? The stock is flourishing for the year. It's up 72%. And for the last 5 years, it's up 400%. So it's down today. It's pretty volatile because it was up almost 4% in regular trading, and then it dropped. So what did investors not like? Not quite sure. Let's take a look at this story, see if it tells us what's going on with AMD. And so revenue in the quarter was up 18%. In the previous quarter, I don't know why they're putting that there. Maybe sequential growth. Yeah, probably sequential growth. Quarter over quarter is up 17%. Year over year, it's up 18%. Okay. And gross margin is doing well, 50%. Okay. And net income is there. Looks good. What I've always disliked about AMD is that they don't generate a whole lot of cash, believe it or not. I wonder if they're providing other financial statements here. Maybe the outlook is what doomed the stock. So they're expecting revenues to be 7.5 million. Where were they at this quarter? 6.8 billion. Well, that's pretty good growth. That's pretty good growth sequentially. Maybe the market was expecting for them to boom even further. Maybe that was the cause for the stock really dropping. All right, so see if they provide. So this is statement of operations, which is a different point of view on the income statement. The balance sheet, I don't think there's any problem with the balance sheet. Let me take a long-term debt isn't very high. I believe they have more cash than they do debt. They do. So balance sheet's in good shape. Usually where I don't become all that enamored with this stock is the cash flow isn't very good. If you look at year-to-date 9 months, they're generating basically $1.3 billion of free cash flow in 9 months. If I annualize that number, I'm probably getting closer to 1.8 billion. I'm going to round up to 2 billion. So $2 billion, and their market cap is $269 billion. So I would have to multiply it times 135 to get to that market cap. That is so expensive. And AMD has always been that type of company where their free cash flows have underimpressed me. NVIDIA is way better. Qualcomm, way better. Broadcom, way better. And those are the stocks that I've invested over the past, call it 10 years. AMD was always like, I don't really like the stock. I don't think they generate enough cash. And some investors have done really well with the stock. So congratulations to them. And over this time, I've invested in Broadcom, I've invested in TSM, and now I'm a current investor in Qualcomm. So AMD is down. I think the market really expected far better numbers, and the stock has sold off in after hours trading. Okay, so that's AMD. We are moving down the list. We have these stocks I covered this morning. If you want to hear my comments, watch the recording. Now I'm going to go over Stryker. Stryker provides equipment for hospitals, both for their surgery rooms, surgery tables, hospital beds, that kind of thing. And they have a very good business going. They have a market cap of 136 billion. The PE is a little high at 40. Then forward P is 28. So it looks like it's priced, I'm going to say a little expensively, just based on PE. Dividend is really low. Analysts say it's a little discounted. Now, the stock has been flourishing. It's up 37% in the last year. Over 5 years, 68%. So not a bad stock to be in a portfolio, moving up and to the right. But when we look at, and we don't have the latest earnings here, so we'll have to look at the earnings as reported from their website. Let's see if we can get to their financials here. All right, cool. I think this will give it to us. So let's take a look. All right, so sales increased almost 12%. Very good. Up to $5.5 billion for the third quarter. It was mostly organic. Very good. Earnings per share increased 20%. So that looks really good. I can understand why stockholders wanted to buy into that success. And they're going to guide 2024 organic sales to be in the range of 9.5 to 10% growth. Very good. Very good, consistent growth. And they're tied to an industry that tends to be stable, healthcare. So we got their income statement. They were profitable for the 3 months as well as the 9 months. Assets, long-term debt's $13 billion. They have about $4.5 billion in cash. So they have about $9 billion in debt, net debt. I think that's fine. The balance sheet looks good. They're breaking out revenue by different categories of products. That is interesting, but I'd like to kind of get the big picture and cover the big picture for this company. All right. Looks like they are not going to give me a statement of cash flows. So I'll just have to depend on their historic cash flow to make an assessment. Is Stryker potentially a nice discounted stock that is worthy of additional analysis and potentially me investing in their stock? So when we look at their free cash flow for the trailing 12 months, $2.8 billion, and that's been a consistent number. I'll round up to $3 billion. And at $3 billion, they're $136 billion in market cap. I would have to multiply that number by about 40 to get to that market cap. That is much too high. 40 would be as if it were growing at 50% or 75%, some really, really accelerated growth rate, but they're not growing that much. I just showed you Google Alphabet. Google Alphabet's growing better than Stryker, and Google Alphabet has a better PE. They have better cash flow to market cap. So all those things really favor an investment like Google Alphabet instead of Stryker. So I think Stryker is a quality business. I've only got good things to say about it, but it's not an investment that I want to make. It just doesn't drive as much value when you compare it to its market cap. But congratulations to Stryker stockholders. Hey, you're having a good night and you had a good day. So hopefully this continues to rally for you, and good luck going forward. All right. So this week we've got lots of earnings. What's next? What's next on deck? So let me see a quick comment from Brad listening on the ride home. AMD gaming revenue is down and AI growth did not impress the market. Yeah. AI is really been causing the valuation of these stocks to really go up. And if they don't deliver really exciting growth, the stocks are going to contract because they're just priced so high, 400% rise over the last 5 years. That comes with some accountability that you have to keep growing your business. So we'll see where things sort themselves out. I do think that Google Alphabet, being one of the big cloud companies, hyperscaler companies, they showed that they are continuing to invest a lot more money. So that does bode well for NVIDIA, as well as the other semiconductor companies that provide semiconductors into data centers. So we'll see where AMD goes. But again, as I mentioned, I've never liked AMD because of their cash. You got to generate more cash in semiconductor to get my investment, because there's other alternatives that are far better, in my opinion. All right. So we covered AMD. We covered Novartis this morning, McDonald's, Pfizer, HSBC. We covered Stryker. Let's go over Chubb, which is a Warren Buffett investment. And Chubb was down today about 1%, but it's up in the after hours trading. And what did investors say? Let's see if these guys are going to give us the detail that I'm looking for. So boy, that's a lot of words. Show me a schedule. All right, so here we go. Net income in 2024 just went up 13.8%. That looks good. Show me the revenue number. So return on equity looks good. I know the numbers are really small. I apologize, but that's what I'm working with here. So here it is. Here's net premiums, and the premiums 5.5%. I don't know. It's all that great, by the way. I think other insurance companies like Allstate, Progressive are doing better than that. they should be doing better because premiums have really gone up in value because the coverages have just really gotten expensive. Insurance companies have been having to pay out for more expensive homes, cars, and so forth. So the premiums have gone up. So these guys should be seeing a really nice rise in revenues, which I'm not seeing here. So 5.5 doesn't overly impress me. What does impress me is Warren Buffett's an investor in this company, which is always, people take notice when he invests in a company because it's usually a very good company, an impressive company. So let's take a look at their free cash flow if they provide it to us. And that's the income statement. They were profitable. Their profits did rise, and they didn't give me a free cash flow statement in their press release. So I'll look at what is historically in their financials. Let's take a look at their cash flow, get a sense of where this company is valued. So free cash flow is terrific for this company, $15 billion. Now you know why Warren Buffett likes this company. Look at this cash, beautiful, up and to the left. Really nice upward trajectory for free cash flow. 15 billion. Whoo. That's a lot of cash. And they are a $110 billion company. So this company, I think, is discounted based on free cash flow. They're growing. I would multiply that 15 times 15, and that would leave me with like $225 billion of value. That's well above their current market cap price. Now, I'm not looking for an insurance company, but who knows? Maybe I will. Up 37%. That looks really good. Up over the last 5 years, it's up 93%. Beautiful. That's a beautiful chart. Up 93.74%. Investors ought to be really happy, and you can tell why Warren Buffett really likes that stock. Let's compare Chubb to some other notable insurance companies and see who is the best stock. We're going to have a stock off. I don't think that is a thing. I'm just making things up, just trying to have a little fun. And I'm going to compare Chubb to Progressive and Allstate. And you can see that they're tracking around the same area. We see that Progressive is number one, 55% over the last year. Allstate is number 2 at 48, and Chubb is number 3. So I guess I picked this horse, and I'm glad. I've done well. But all 3 companies have done well. But Progressive was the best horse to pick in insurance. They've done terrific. Congratulations to Progressive stockholders. Congratulations to all stockholders of these categories. Good choices in insurance. And I think it's going to continue to do well in 2025. We'll see. All right. So Chubb announced, Warren Buffett's insurance company announced they're up a little bit in after hours. I was not overly impressed. I think Progressive and Allstate are doing better than that. Maybe that's what investors are looking at and, kind of assessing what they should do with that stock. All right. So we talked, big time communication services technology and Google Alphabet. We talked insurance. We talked Visa. Now let's bring it down to Staples, which is a food company, a good consumer staple company. And this is a pretty valuable company at $92 billion. And over the last 5 years, they've gone up 32%. They've paid a dividend. Collectively, you're probably up 40 to 45% is the return. Not bad for a consumer staple. I don't like consumer staple stocks because I think I'm leaving too much money on the table. I'd rather take a little more risk and over the long haul, make a better return. This is a quality company. I don't want to disrespect this stock. You see up and to the right over the last 5 years, that's a sign of a good quality company operating, doing what they said they were going to do. Growing their business year after year. Look at that growth. Beautiful. Nicely done. Mondelez, very nicely done. Now, I own Kroger, and that's the one consumer staple stock that I have. I'm happy with Kroger. It probably has a return similar to Mondelez. But this stock could be good for somebody that's looking for a nice dividend at 2.7% and is looking for a nice stable stock. Maybe somebody that's a little older and doesn't want to bet on the big growth stocks, the technology stocks that are booming, but maybe are going to start to struggle in a couple of years. Mondelez, we're going to need food forever. So they're going to have demand forever. And you saw their performance. They keep growing well, and the company is very well operated. So this company here, good job, up 0.51%. Investors are approving the earnings. But as you can tell, food companies are not going to just be like, Google Alphabet that's, going up substantially. Even though they're a $2 trillion company, it's up more than 5%. I mean, that alone is $200 billion of market cap addition to that stock. You could have bought two Mondelez companies with just the increase in stock price for Google Alphabet. So nice job, Mondelez. Good job to all the employees and stockholders at Mondelez. All right. So the problem I have with talking about food companies is it usually makes me hungry. And now I'm going to talk about Chipotle, which is a place that I like to eat at. So I'm probably going to have to head over to Chipotle after I finish my live stream and get a bite to eat. But before I do so, let's cover the stock. It's down 4.73%. In general, I do not like the food industry, the restaurant business. It's just really difficult. I'd rather buy into Google Alphabet. Man, those guys are really smart, and they have a really strong business that has really good competitive barriers. I like all those things behind that business, but the restaurant business really brings a lot of undesirables. For example, McDonald's had the E. coli breakout. Holy smokes, that is brutal. And they've recovered quite nicely, but still, that's one of the risks you run when you run a restaurant. You also have to hire a lot of people. You have perishable ingredients. I don't want to cry on your shoulder about food companies and restaurants, but that's what you have to deal with. And with Chipotle, you're dealing with a very high PE. So after buying a business that I don't think is all that desirable, you have to pay a high PE. No, thank you. I'd rather pass, but that's just me. Forward PE is 51, still really expensive. Analysts think it's a buy, and it's discounted by 4.3%. Let's take a look at their growth. So they've been a growing business. That's one thing you have to give them credit for. They've been growing quite nicely. Now let's take a look at their margins. Do they have big margins or small margins? So this is their gross profit. And on $10.6 billion of sales, they're at $4.3 billion of gross profit. So if I divide 4.3 by 10.6, we're going to get to roughly about 38%. Not bad at all. But it's not as great as like some of these high-flying companies like Visa and Google Alphabet and so forth. So I'd rather be in those businesses that have higher gross profits, higher likelihood of growth. And Google Alphabet's growing faster than these guys, or about the same, I should say, for the current trailing 12 months. So all things considered, congratulations on the growth to the Chipotle team. I'm not quite sure why the market is selling off the stock. Let's see if some of these headlines tell us. The outlook disappoints. I think there is some concern around avocado prices and food prices, which could really shrink their margins. That definitely could be something that could be a problem going forward. And investors are really trying to get their heads around it. It is a pretty high market cap for a restaurant stock, $82 billion. That's pretty expensive. Probably the most expensive restaurant stock is McDonald's, and they've been around forever. They have a different business. They're more like a real estate investment trust versus a full-fledged restaurant stock like Chipotle. So, and if you look at the McDonald's gross profit, it's much higher. I did that analysis this morning. It is much higher. So I've always passed on Chipotle. I just didn't want to own a restaurant. I'm careful with restaurants and have not really warmed up to them a whole lot. If you are a stockholder of Chipotle, you are very happy. It's up 286%. So over the last year, it's up 60%. So you could have made money on Chipotle. Not me. I picked my lane. Okay, I passed on this one, but I did make money on some really good winners like Meta, TSM, and the likes. Broadcom, I owned and sold, and they had similar returns. So I'm going to stay in my lane and try to pick the industries that I think I can get my head around most and really believe in. And I think that over the long haul is going to result in better performance for my portfolio, and I'm going to make consistent money going forward. So Chipotle is having a bad evening. We'll see if things pick up for him tomorrow. But I think another story to draw out of this is they lost their CEO. Their CEO is doing a good job, and he left to go run Starbucks. And maybe investors are losing a little bit of faith in Chipotle that they lost their fearless leader. And maybe that has something to do with the drop. I don't know, but we'll see how it goes. We'll see if the stock goes down further and where it ends up. So that is Chipotle, and we'll see how that company goes. Just to recap on desirability, we covered Stryker. I think they have some competitive advantages. They know how to make, surgery room equipment. Hospitals are very comfortable with them. They make their equipment in unique use cases, so they belong partially in the green. I covered Bitcoin. There's only one Bitcoin, and the supply keeps diminishing. So it creates scarcity. And now the Bitcoin is above 72,000 per coin. It may hit 100,000 very quickly. We have an election. The acceleration of the appreciation is really interesting on Bitcoin. I'm not buying a lot of Bitcoin right now, but I would not be surprised if we're sitting here in 3-4 months and it's above 100,000. But we'll see how it plays out. And that is definitely in the green. We covered Google. It's definitely in the green. Chipotle belongs in the gray. It's a restaurant. And although they're a very good brand, people like them, they're a restaurant. So they don't have barriers of entry. People can go across the street and go to McDonald's. They can go, down the block and go to the pizza shop. They can go to the other way and go to the Italian food place or the Chinese place. There's just so much competition in restaurants that, I just would rather not invest in them. Chubb is also in the gray. Although they're a very good company, I showed how Progressive and Allstate actually outperformed them. But they're a good company. And of course, Warren Buffett is an investor. We went over Visa, and I commented that Visa is a very, very good, desirable business, but it stands to lose some of its market share to the new forms of payment. AMD is just a semiconductor company, and I don't like the free cash flow they produce. I wish they produced more. I haven't invested in AMD for those reasons. Then Mondelez is a good, stable food company operating really well. For an investor maybe that's a little older and very risk averse, that'd be a good stock to consider. For me, I own Kroger, and I'm good to go on a consumer staple stock. So there you have it. Those are the earnings for today, Tuesday, October 29th. Man, it's just going to keep coming. I'm going to try to live stream in the morning because it's going to take a lot of effort to keep up with this market. I'm glad that the market's doing well. My portfolio is up for the month of October, and it's really up for the year to date. Man, I am doing great, and I appreciate it, stock market. If I could really end the year at this point, I would be good. I'd be happy just, hey, if I end the year now, I'm good. I've made a very good return. I'm already focused on how can I position my portfolio to really perform next year. So if you want to be a part of this community and communicate with the other investors that are paid investors, consider joining and becoming a paid member of our community. There's 3 options. There's more details on the description of the live stream. And the advanced investor gets you to the investor calls on the weekends. We're having really good investor calls where you can come in, listen, participate, bring up ideas, bring up stocks you want to cover, bring up concepts or lessons that you want to learn, and we'll put those into the agenda at some point and cover them. So if that's something you'd like to do to advance your skill set as an investor, sign up. I think it'd be worth it. Give it a try. So that is it for today, guys. I appreciate you tuning in. I hope you all made lots of money today, and I hope you make lots of money tomorrow. Let's see what the stock market does tomorrow, and I'll talk to you soon.